Hello. Hi, and Andrea. Can you hear me?
Yes, I can hear you.
Good. All right. Well, looks like it's just you today. So before I get started, since it's just you, did you have any specific questions you want to ask, or did you just want to hear the presentation?
No, I just want to listen to your presentation.
Okay. All right. Well, if you think it's something as we're going, just jump in. Okay.
Okay.
All right. All right. So, can you can see the PowerPoint presentation on the screen, right?
Yes, I can.
All right, good. So we are going to talk about adjusting entries in the worksheet, which is subject to what we're doing for this week, and we'll also do it for next week as well. So let's jump into it. And end of the period adjustments. So what happens with adjustments is this: as we're going through the accounting period, we have certain transactions that we do. And certain transactions are pretty straightforward. If you say you buy a piece of equipment, or if you pay for a utility bill, etc., those are straightforward. We've been talking about how to do the journal entries for those, right? But what happens when you buy something ahead of time, or you buy something that you use it throughout the period, right? So you buy let's say you buy office supplies, and then you use those office supplies throughout the period, and then you have to go back and say, okay, well, how much office supplies do I have left? Because when you do your financial statements and when you report out to people, you want to know what are the costs for what do you have left on hand. And so this is where these adjusting entries come into play. So let's take a look at the slide. It says changes occur that affect the business's financial condition. For instance, when equipment wears out. So when you bought that piece of equipment, let's say it cost you $10,000, and at the end of the period, is it still worth $10,000? And so when I report out to people, I say, hey, I've got a car, I bought it for $10,000, and to say at the end of the year, and I've been using it, and it's still worth $10,000 is not accurate. So how do we fix that? What about if you prepay something, as I mentioned earlier? You get insurance at the beginning of the year, and you prepay for it for a couple of years in advance, right? And or you get it in the middle of the year. You get it in June, and it's going to last until next May. So how much of that insurance is left when you get to the end of the period, whatever that period is? Or if you have employees who've worked, and maybe at the end of the period they work, their paycheck is going to come out after the period is over, but they worked in the previous period. So in order to accurately show how much that person worked in the previous period, you got to be able to show that. So all these things require what we will call adjusting entries. All right, so these events have not been recorded in the accounting system because we're not sitting around looking at the car and seeing how much it's worth today and then do a journal entry for 365 days of the year. No, we just do it at certain times. We do it at the closing period. So that's what we'll look at. All right, so there is something called the revenue recognition principle. And here's the idea is this is that you can only record revenues when you earn them. So uh, uh, revenues are considered earned when you either sell the product or provide the service. But what happens, and let's see what happens. It states that expenses should be recognized. It also states that expenses should be recognized when they occur, and expenses are generally considered incurred when the services are received or the assets are consumed. All right, that's a lot of fancy stuff, but let me just kind of go back and just kind of explain what that means. Revenue recognition says, look, you can't say that you've earned revenue until you've done everything you need to do. So if I sell magazine subscriptions, and that's what I do, and a customer pays me up front, I want to pay you for the whole year of magazine subscriptions, or you prepay your cable, right? And you, let's say for whatever reason you prepay your cable for the whole year. Now, has the cable company provided you the service yet? No. And so they can't say that the money that you prepaid them, they earned it. Um, all they can say is that, well, they owe you a year's worth of cable because you paid for it already. So the company, the cable company, even though they've got money from you ahead of time, what do they do with it? Do they just act like it never happened? No, they can't do that. That something did happen, that you gave them money, but did they earn that money? No, they didn't. So how do you record the fact that someone gave you money? Well, that's what we mean when we talk about, and we'll talk about this later, we'll talk about accruals and deferrals. Also, on the flip side of this, if you have an expense, let's say you use utilities, you use gas, you use heat, you use a phone, and in some cases, you don't pay for that until after it's been used. And so you got something ahead of time and you pay for it later. Or let's say you borrow money, right? Or let's say you have an account with a vendor to give you all your inventory, and they give it to you on account, and you have 90 days to pay it. Well, you got something and you did not pay for it. We need to record that as well, even though we didn't pay out cash. And what the key thing here is cash flow. The difference between cash flow, whenever we actually pay out cash or get cash, and when we actually have done something to earn that cash, or we have done something that needs to have that cash paid out, that's what makes what we do in accounting a little strange. So let's look a little bit deeper into it and see if it helps, if we can figure out what to do with these adjusting entries. There's another principle that we have to think about. It's called the matching principle. And this says that revenues, when you get revenues from doing business and you have expenses, you have to match them. In other words, if you got in a year $100,000 in revenues, what did it take to get that? All right. How much of your resources did it take to make 100,000? Because we know money doesn't fall off trees. You had to do something. It takes money to make money. And so what the matching principle says is whatever it took to make that revenue, you need to record it. And it doesn't matter if you pay cash or not. If you did it and it happened, that's part of what it took to make those revenues. And hopefully this will get a little clearer for us as we go on. We also should understand that a fiscal year is typically a 12-month period, but it doesn't necessarily have to end on December 31st. Some companies start in October, and they end in September of the next year. Microsoft is an example of a company that does that. All right, so now let's talk about adjusting entries and why I had to talk about all that other gobbledygook in order for us to understand this for adjusting entries. All right, so here's an example of something. During June, Rohan purchased supplies for $80. When you purchase those supplies, we get that, right? You put the supplies as a debit in your supply account because it's an asset. When your assets go up, you put it on the left side of your T account. And anytime you put something on the left side of the T account, it's called a debit. So we debit the supplies here when we purchase those supplies. Also, it says during, they debited the supplies account, and according to an inventory of supplies, there are only $20 of supplies on hand at the end of June. So let's think about this. Let's say, for the sake of simplicity, we bought these on June 1st. And then on June 30th, we go and look in our inventory, whether it's a cabinet or it's a closet or it's a room, and we actually do a physical count. If you ever worked in retail, you've probably done this before. You went around and you looked at all of your items. You saw what you had on the shelves. You went in the back of and every end of the month and end of the year, just depending on when you did it, you went around with this little gun. You zap stuff to see how much was there, right? And so here, that's what we're doing. We're seeing how much supplies we have on hand. It looks like we started with 80, and now that we check at the end of the month, we have 20 left. So now here's what we got to think about. You have to keep this in mind. We bought those supplies in June, and when we bought them, we had not used them yet, right? As soon as you buy them, you put them in a closet, and they have not been used. So technically, those supplies, even though we got them, we did something to get them, those supplies have not been used So we cannot call the purchase of those supplies an expense. Why? Because an expense is really only the use of something we purchase. So if I have these supplies, $80 worth of supplies sitting there, that's an asset because it hasn't been used yet. So anything I have that's I can use later is not an expense because an expense is it's been used. So if I have supplies on hand, that's an asset because they haven't been used yet. However, throughout the period of June, I've used up a certain amount of supplies. And as I look at my closet, I see where there's $20 left. So I'm going to ask you guys a question. Carrie, I see you joined us. I'm going to ask you two a question, see if you can answer. You can chat your answer if you like. You can say it. But how much of the supplies did we use if we started with 80 and we looked in the closet and saw 20? How much of the supplies did we use? Andrea, Carrie, any thoughts on that? What do you got? I see your hand, Andrea. What do you have? Yeah, that's it. I see your chat. Absolutely. 60. So we use 60. So that 60 that we actually used, guess what? That is the expense. Remember, an asset is something that we haven't used, an expense is something that has been used. So in this case, we have an expense because we use $60 worth of supplies. Now, unless we do an adjusting entry, who's going to know that that happened, right? Who's going to know that somebody went in the closet and took a look and saw there was only $20 left? Well, we have to do something. We have to adjust this account because it's not $80 anymore. It's less than that. So how do we do it? All right. Well, we know that $60 of supplies was used. 20 remains. So what needs to happen? We have to have a $60 adjustment. We can't do it this way because remember, in our accounting, anytime we have every transaction we do affects at least two accounts. So we know our supply account needs to be affected, needs to be adjusted by 60, but something else needs to be adjusted as well. Supply expense. Here's a clue for you. Anytime you're doing an adjusting entry and you're dealing with the use of an asset, you're always going to have some kind of expense as your other account that's affected. So if we use supplies, it's called a supply expense. If we use utilities, it's called utility expense. If we use up rent, it's called rent expense. If we used up insurance, it's called insurance expense, et cetera, and so on and so forth. So here we have an adjusting entry. What do? We credited supplies because remember, anytime we put something on the right side of an asset to account, it's going to reduce it. And all expenses, every single expense, every expense will always be a debit. So here's our debit, here's our credit, and here's our adjusting entry: debit supply expense, credit supplies. So before I move on, Carrie, Andrea, any questions on that? You can either use your microphone or you can chat. Any questions on that? All right. Now notice after we've done our adjustment, 20 of supplies is left on hand. That's our account balance started at 80. We reduced it by 60. 20 is left. We created a new account, supply expense, so its balance is $60. All right, prepaid insurance. All right, so during June, Rohan paid $200 for an 8-month liability insurance policy. Okay, 8-month liability insurance policy. So they paid $200 at the beginning of June, let's say June 1st, and it's an 8-month policy. So that means we're going to use it for June, July, August, September, October, November, December, January. So at the end of January 31st, it'll be all used up. So if that's the case, when I buy it on June 1st, have I used any of it? Actually, this is from the PowerPoint presentation. So not quite sure, Carrie, I'm not quite sure what number it is, but it's from the week 5 PowerPoint presentation. So again, not quite sure what slide this is. Let's see. Looks like it's slide 19. Slide 19 from the PowerPoint presentation. All right. Okay. So again, with prepaid insurance, we at the beginning of June, have we used any of this insurance when we first purchased it? Has any of it been used? No, it has not been used, and it won't be used until until the passage of time. So we can't say that this is an insurance expense. Why? Because it's not been used. And so what do we call it? Instead of insurance expense, we purchased that insurance, we actually call it prepaid insurance because it hasn't been used yet. And so this is an asset account. Remember, an asset is anything that I can use in the future. I can still use it. If I can use it, it's an asset. So I have it, and I have $200 worth of this asset sitting in the account. Now you know what we're going to have to do, right? So at the end of June 30th, how much insurance, prepaid insurance, do we have left? So I want you to think about this. So chat and answer for me, or use your microphone. I want you to think about it. At the end of June, we purchased this on June 1st. On June 30th, how much in prepaid insurance do we have left? Or said another way, how much of this prepaid insurance have we used in the month of June? That's it. Yes, that's right, Andrea. We used $25, right? How did we get that? We took 200 and we divided that by what? 8 months. 200 divided by 8 months gives us $25. So if we use 25, how much prepaid insurance do we have left at the end of June? That's right, Andrea. Absolutely. And so our adjusting entry, remember I told you, anytime you use an asset, the other account that we're going to use is some kind of expense account. In this case, insurance expense. Insurance expense will be our other account affected in this adjusting entry. All right. Okay, so this was a little tougher, but that's okay. Same principle. Rohan paid his part-time employees $650 on June 27th. Since then, they have earned an additional $50, but they haven't been paid. So I want you to think about it. Rohan, up to June 27th, has paid his employees, or her employees, I should say. Not quite sure if it's him or her, but Rohan has paid the employees $650. However, they worked. They continued to work. They didn't stop working on June 27th, right? They worked on June 28th, June 29th, and June 30th. And so for those 3 days, Rohan owes the employees an additional $50. Now remember, we can't go, and that was only 3 days, and there's probably 2 more days we have to think about, but those other 2 days will be July 1st and July 2nd. That's a whole new month. And we're not worried about the new month right now. We'll get to that at the end of July. Right now we care about what happens in June. So we have $50 that we have to account for. But here's the thing, it hasn't been paid. Should we just let it go and not worry about it? No, we can't do that. We have to record the fact, because when we get to June 30th, we have to tell people how much we owe. And in this case, yeah, we paid $650, but we still owe $50. So in this case, we got something, but we didn't pay cash for it. That doesn't stop us from making some kind of journal entry, because we got something in this transaction. What do we get? We got work. We got people who work for us, and to the tune of $50, right? So we got $50 worth of labor. How should we record that? Well, we know, first of all, that we have an additional wage expense. We have an additional wage expense of $50, but we didn't pay cash for it. So I want you guys to think about it. So Carrie and Andrea, what should be the other account here if we didn't pay cash for it? How do we record the fact that people have worked for us? We owe them $50, but we haven't paid them yet. How will we record that? Chat your answer or use your microphone.
So would it be up on account payable?
It would be a payable, but think about it.
Account receivable.
No, it's a payable. You're right about payable. But what kind of payable? Wouldn't be account payable, because account payable will be more about the inventory you purchase. So I'll give you a hint. The word is right in front of you on the screen.
What, wage expense?
Yeah, wage payable. It's to be a wage payable.
Wage payable.
Yeah, anytime you owe somebody, you call it a payable, but it depends on who you owe. If you owe the vendor, you call it accounts payable. If you owe the workers, you pay it wage payable. If you owe the utility company, you call it utility payable, right? So that would be the case here. And so we would create a new account, or we add another account here in this example, right? We need an adjusting entry, $50 more to our wage expense, and there it is. Make sense?
Yes, that makes sense.
Good. All right. Now our wage expenses go up to $700. And with each adjusting entry that we do, we have to keep in mind that these account balances are going to change. All right. So in our previous example with the rent, that account went down, the prepaid account went down. In this case, with the wage expenses, it actually goes up. Supplies, that account went down as well. All right. The historical cost principle says this: when we buy a piece of equipment and we record it, we put it on our balance sheet and we don't change the amount that we bought it for. So if I bought something for $100,000, I'm going to leave it on my balance sheet as $100,000 all the time. But you say, wait a second, if you're using it up, doesn't the value of this thing go down? It does, but we don't change the actual count. We don't say equipment is now, it was 1,000, but now it's 500. We don't do that. We actually use a different process for that. We have something called depreciation. Have you ever heard that term before, depreciation? If you have heard the term depreciation before, it simply is the use of a long-term asset. So when we talked about supplies and prepaid, we use an expense, right? When we were talking about the use of those, but those are what we call current assets or short-term assets. When we talk about an asset that could be used for more than 1 year, we're going to use the same idea, but we're going to call it something else. We're going to call it depreciation. And so in order to find depreciation, it's very similar to how we found out how much of the supplies were used, how much of the prepaid insurance was used, same kind of idea. But we have something called a useful life. And what a useful life says is, if I buy a car, how long do I expect to use that car? And let's say for our purposes, it's a 5-year car. Well, then it has a useful life of 5 years because I can use it for 5 years. I also need to have that number because what I'm going to do is I'm going to, each period, I'm going to say how much of this car I have used during the period. Because if I buy a $10,000 car today, I can't say I have $10,000 of expenses related to that car because I haven't used it. I can only say of the amount that I have actually used the car is the amount of expense that I can have from that car, or in this case, the amount of depreciation I can have in that car. So let's take a look. Salvage value simply is, after I'm finished using it, how much could I sell it for? Could I sell it after 5 years for anything? And if so, that amount that I could sell it for will be called my salvage value, also called scrap or residual value. So if you see these three words, they're all interchangeable. Okay, so here we go. Rohan has motor scooters, and they have estimated useful lives of 3 years. There is no salvage value, and we paid $3,600 for these. So that means at the end, after the 3 years is up, Rohan doesn't believe that they could sell for anything. All right, so let's take a look at what this looks like. So we're going to spread the cost of this thing over that 3 years. So here's the formula that we use to find depreciation. First step, find out how much of this asset we can depreciate. Well, it costs us $3,600, so we start with that. If there was a salvage value, we couldn't depreciate that because we're going to sell it for that amount. In this case, there is no salvage value. So the amount that we can depreciate is the entire $3,600. So before I move on, Carrie, Andrea, does that make sense? Do you understand so far? All right. Next step, after I found out how much I can depreciate, I'm going to simply divide it by its useful life. In this case, 3 years, but we're looking at months, aren't we? And so a year is 12 months. So really what I need to do to find out the depreciation for each month, because I close at the end of each month, I need to divide it by the number of months. So 3 years times 12 months is 36 total months. So I'm going to depreciate. I'm going to take a piece of this, of the cost of this item for 36 months. And so let's find out 3,600 divided by 36. Well, I think that's pretty straightforward, but let's see what the answer gives us. So each month, I'm going to take $100 of depreciation. In other words, I'm saying that I used $100 of the scooter each month. Now, is that actually the real case? No, it may not be. It may not be. What we're doing is we're using what's called an allocation method. We're just spreading it out evenly. It could be used more or less, but for the purposes of doing our journal entry, we're just going to say, look, we use $100 every month. That's the way we do this. So now let's do our adjusting entry. All right, so we have delivery equipment of $3,600. But remember what I told you about that original cost, the historical cost principle? We're not even going to touch this T account when we do the depreciation. What we're actually going to do is use a different account. It's called accumulated depreciation. Accumulated depreciation. We're actually going to use that. And what this account is called, it's called a contra asset account. And all that means is every time you see this delivery equipment account, this account will be right behind it. And what we do is notice that that $100 went to the credit area, and the delivery equipment, that amount goes into the asset area or the debit area. So we just take the difference between these two to find out what's left. And so when we look at a balance sheet, we'll see this amount, and this will be right underneath it as a negative. And so we'll see is that the equipment actually has a value of 30, or what we call a book value of 3,600 minus 100, or 3,500. Now, okay, we've got the credit entry, but what's the debit entry? Glad you asked. Depreciation expense. All right, again, notice the asset that we only do this for long-term assets. Anything that we can use for more than 1 year, we won't touch the actual T account for that. We'll use the accumulated depreciation account for delivery equipment. Notice it looks just like we did for supplies, right? Because there it is, depreciation expense, right? For supplies, we had supply expense. For insurance, we had insurance expense, right? But for when we have long-term equipment, we're going to use an accumulated depreciation account, and we're going to have a depreciation expense account. All right, so does that make sense before we move on? Any questions on that? Make sense? All right. So once we've done that, we have all these adjustments. What we need to do, remember we talked about this last week. We talked about the process of journalizing, then posting to the ledger. We have to post to the ledger. So what happens? How do we post these entries? So we did our journal entry in the general journal. Here it is right here. And so here's our supply expense. Here are supplies. So these are the entries that we're doing throughout the period, right? From June 1st to June 29th, right? We're doing these entries in our general journal. On June 30th, here's our adjusting entry. On the 30th, we plop it into the journal. We have to transfer each one of these amounts to their proper accounts, because remember, the ledger keeps each account separately. So there's one page for supplies, and that account, anything that has with supplies. There's another page, right? That account, it just deals with supply expense. So in this case, we have to take the $60 from supply expense and post it to the supply expense ledger account, right? Here's a page just for the supply expense in the ledger. We also have to do the same thing for the supplies, right? It has to go from 80, subtract 60 down to 20. All right, so notice here what's happening here. Put our debit in when we purchased the supplies. And then when we do our adjusting entry, we take that, right, credit for supplies here. So that means we started with 80. Now we're going to reduce it by 60. That makes it, now it has a debit balance, $20. Same thing happens for the insurance expense. We're going to take that $25 debit and move it into the insurance expense ledger account, right? So there was nothing there. So we posted there, right, $25 debit, and it has a balance in the T account of $25. We take also the prepaid insurance. It started at $200 debit balance. We use 25 of it. And now, because we use 25, it still has a debit balance, but it's a $175 debit balance. finally, I'm sorry, not finally, but for our wage expense, the same idea, posted those accounts, and depreciation, that's our final entry, we posted to those accounts. All right.
Okay, I have a question.
Yes.
Okay, so when you're doing the corrections, are you doing it on the ledger or the which one are you doing the corrections on?
Okay, not adjustments, you're talking about corrections, right?
Right.
All right, so it depends. It depends on where you put it. So if the correction needs to happen in the journal, you can do it right there in the journal, right? You can just reverse those accounts. All right,
Okay.
so if you haven't posted yet, you can do it right there in the journal, okay?
In the journal. Okay.
If you have posted, that's where you'll have to scratch out and make your corrections there. Okay?
Okay.
All right, so make sense?
Yeah, because I was trying to do a correction on one of the assignment and it wouldn't let me do it. I guess I was doing it on the wrong one.
Okay.
Okay.
Was that week 3 assignment or week 4?
Week 4.
Week 4?
Mm-hmm.
Was that the part 1 or part 2? Part 2?
Mm-hmm. I think it was on 2.
Okay. I could take a look at that, see what that is, if you remember what it is.
Okay.
Okay. All right. Real quick. So here we have our adjusting entries. Here's in the ledger account. And we need to say that what this is an adjusting entry. Same thing here. Adjusting entry. Now let's look at the worksheet. What is the worksheet? The worksheet pulls together the trial balance, the adjusting entries, and it prepares all the financial statements. So it's all in one place, and there are 10 columns. So in your part 2 assignment for chapter 5, you'll be dealing with a couple of these worksheets. So let's take a look and see how that works. 5 steps. First, we have to prepare a trial balance. We do the trial balance by taking all of our T accounts, right, and putting them in each one of their respective columns. Then we'll do our adjustments. We'll put those in their respective columns as well. Well, now that we've done an adjustment, we'll have to do an adjusted trial balance, right? Because the first trial balance didn't have the adjustments in it. And then what we'll do is we'll take those adjusted balances and we'll move them over to the income statement and the balance sheet. So let's see how this looks. All right, so headings include the name of the company, the name of the working paper, the date of the calendar period that just ended. We have to prepare the trial balance. All right, before we look at the adjustments, let's just take the accounts right out of the ledger, right? And we're going to put them into a trial balance. So here, what do? We just went to our T accounts, and whatever the ending balance was, we put it right into the trial balance. So if it had a debit balance, we put it on the debit side. And so all of our assets, they should have these debit balances, right? So we have prepaid insurance. It started off at 200, right? Supplies were 800. These were all debits when we did the T accounts. The accounts payables, right? They were all be credits when we did the T accounts. Next thing we have to do, we just take these straight out of the general ledger. Next, we'll do the adjustments. So in our case, we've done the adjustments already, but when we're doing a worksheet, we wouldn't have done these adjustments yet. But it helps us because we've already looked at them. And so we can go ahead and record. Let's record these adjustments that we computed earlier. So what happens? All right, so let's take a look how this works. In our adjustments, we had a debit and a credit, each one of those accounts. So in our debit, the supply expense was the account that was debited. So we're going to put the $60. And notice we have an A here. And the reason why we put the A here is because we want to match these two entries. Because if something's not right, we want to be able to go back and say, okay, here's A and A. Make sure they're the same amounts. And if we need to go back to our ledger or the journal to check them out, we can do that. So we label them with A. Right? So we put the $60 credit. Again, this is straight from our general ledger, right? And from our journal. We pull this information, put it right here. So our supplies went down by 60. Our expense went up by 60. We'll do the same thing for the rest of our adjustments. So we have 4 adjustments, right? We have for supplies, then we have for prepaid insurance, and we have one for wages payable and for accumulated depreciation. So notice these should match. It should be the same amount on both sides. But again, remember, whatever account it affected is where we're going to put those amounts. Any questions so far?
No, no questions.
In this case, they balance, so we're good. Now, what we need to do, the next step is we're going to create an adjusted trial balance. And all that is to take these accounts, combine them with these adjustments, and move them over here. So in the case of cash, were there any adjustments? No. So we just take the debit 370 that was here and just move it over here because there's no adjustments. Same thing with accounts receivable. No adjustments, so we just take that amount, move it right over here. Now we get to supplies. We started with 80, which is a debit. Now we have 60, which is a credit. How much should go in the adjusting trial balance and where should it go? So what do you think? Chat and answer or use the microphone. How much should go into the adjusted trial balance and which column should it go into? Credit or debit column?
Okay, would it be 20 in the credit column?
Well, again, if we start with 80, we reduced it by 60, is which one's bigger? The debit or the credit? So it should go in the debit column.
In the debit column?
That makes sense?
Not really.
Okay, so here, it was $80, right, in the debit here, right?
Uh-huh.
We just subtracted 60. And all we're saying is, what is the balance of the account now?
So it was 80 and you subtracted 60. How would you still end up with 80?
No, if we start with 80, subtract 60, should have 20, right?
Right.
Now, remember, just like with our T accounts, think of this debit side, credit side, right? Debit side, credit side. When you foot those and you have a balance left, which side does it go on? It goes on the bigger side, doesn't it?
Right.
That's a debit.
Debit side.
So this, all we're saying is you still have $20 of supplies left.
Okay.
That's why it goes from the debit side. Remember, your assets always have a debit balance. So you should never have a debit, or should never have an asset that has a credit balance. If you do, something's wrong. Okay?
Okay.
So when you're adjusting trial balance entry, your assets should all fall into the debit side. Even if you're subtracting stuff from it, whatever the remainder is should still go in the debit
In
side.
the debit side.
Okay?
Okay.
Now let's look at, what about here? Prepaid insurance, same thing, right? Started with 200. We get an adjustment of 25. So we have a balance left of 175. Should go in the debit column. Okay? What about delinquent equipment, or sorry, delivery equipment? Any adjustments there? No. So we simply take the debit amount here, move it to the debit amount here.